99.8% of the investors lose money, these traders, even when the market is going up. That's fun. Not when it's going down. I understand, because they get into derivatives, they don't understand options. They think that writing options is free money, and without understanding the payoffs. Even when markets are doing good, these day trader kind of people, they lose money. So
I have a very simple rule. Whenever I put money, I lose money.
No,
except for the first year that I put, then it became addictive.
Yeah, it becomes addictive, and I think I'm not saying there are no people who are skilled. There will be people who are skilled, but on an average,
is it an art that you can learn?
I don't know. I'm not an expert trader. I'm an academician, so I should not be talking too much about trading. But then there is a very good book. The Reminiscence of a Stock Operator. Anyone who is interested in trading should read that book. Okay. This is by somebody called Edwin Lefferway. This was written in 1920s. This guy was so successful trader in the US. That time it was a concept of bucket shops. There was no brokering and all this market making. So you go and bet in a bucket shop. And people had... so he was so famous that he would always win. It's like a bet that this will go up or go down. They had banned him. Almost all bucket shops, because the other side would lose. It's a zero-sum game, unlike now. Yeah. So then he had to disguise and send someone else to trade. But people figured out that this is this guy's person. Right? He had become that famous. So there are some people like that. But his point is, so he has a very famous statement that it is not about being right. It is about sitting tight when you're right. So it's averaging up, not averaging down. That's what you would follow. So he realized that it's only some of the bets that you will win, because market shows momentum. So this, my friend, made money. So it was small. So 10 to 15, 1 lakh becoming 15 lakhs. What if he had put in 10 crores? It would have become, whatever. He would have been at a different level.
He could have contested elections.
So the reason is Tata Elxsi, because he sat on Tata Elxsi unknowingly. It was unknowing.
If he had known, he would have
sold it long back.
2 lakhs, 1 lakhs.
Long back he would have exited. So Tata Elxsi, there is no way he would have sat on it, because you would have thought 10,000 now has become 30,000. So so those who can overcome that temptation and understand that this is a momentum game, this is not an averaging game. So winners will keep winning. Google will keep winning. So it's once you're having, there are a lot of people who invested Infosys early, but there are very few people who have made their 10 rupees into whatever lakhs today. So that's what he says. It's not about just being right. He says it's easy to be right, but can you sit tight when you're right? That's a question people should ask themselves. So if they can do that, and then do you have stomach to take losses?
That's interesting. True.
So that's traders. I think there are such people should trade, but on an average, at least I'm not a great trader.
So you would advise that whatever investments you make, you make into a lot of make it more diversified.
Yeah. For people like
rather than putting one sum in one stock or two stocks, you thin it out, right?
Unless you have a reason to believe that this is a next Google or something, and let's say you have expertise on something, and or you use a product of a company, and you think that this is so good that this is going to be the next thing, and market has not figured out.
But most of the investors we know are not like that.
Yeah.
They are not going to go into the company's financials. Yeah. They are not going to say research on what products it is coming up with and all that.
No, They don't do that. But there are people, for example, Peter Lynch, again, another book your viewers should read, those who are interested. It's a very famous book, One Upon Wall Street. Okay. And he was considered the most successful fund manager ever in the 90s. So his point is, his whole thesis, which I may not fully agree with, is that people like you and me can outperform professional fund managers. His point is, we don't operate within those restrictions within which they operate. Monthly performance, quarterly performance, investors, pressure, year-end bonus, when we put in our own money. So his point is, look carefully what your children are buying, what your spouse is buying, what your neighbors are buying. And that should be the starting point for a equity research. And suppose you stay in a hotel, and if you like that experience there, and once you start liking some product, then you start your equity research. Find out whether it's a listed firm, and look at its valuation. Find out what their competitors are doing. Talk about various other people who. So his whole research was he considered investing as a art, science, and legwork. So if you're willing to do that legwork, visit the facility, talk to competitors, and the biggest sign he would say that if competitors, he would ask a competitor, who is your biggest threat? If most competitors say this guy is an upcoming threat and all that, and then the market has not figured out, and he was famous for 10 baggers. For example, he found a company which was that time doing this funeral service. In the US you have this concept, people pay for their own funeral, and you can pay like an insurance because funeral space and coffin, and such a dirty whatever you call it. And he figured out that that's,
or you can look at it the other way and say noble also.
Whatever. So, but not something which is fancy.
Mainstream.
I didn't mean that time.
Yeah.
And he figured out some toys like that. Children were using toys. Some women's wear based on his wife's feedback. So most of his, what he shows in his book, most of his so-called 10 baggers, he was famous for 10 baggers. He buys and price multiplies 10 times. Where through this kind of research and not using these fancy computers and talking to analysts and all that. So his whole thesis is quite opposite of what I'm saying. So his thesis is that you and me can outperform if you are willing to spend that time and effort, and you need not be a fund manager. But I don't think people will do that. It's legwork is important. That legwork is the most important point.
Yeah.
So it's better to passively invest in index.
Yeah, because people don't have that kind of time also and inclination also.
Yeah.
See, once you do some projects, say you do for two companies and you make money, then you have an incentive to do that, right?
Yeah.
But people are not connected to that kind of world. So only professionals are there who maybe their friends, they will maybe talk about that and maybe train them or something like that. So maybe they will say, "Arey, my friend is doing so good. Maybe I should try." So something, but that world is so different from because it's very nascent at nascent stage even now, right?
So, but his whole point is you don't need these sophisticated things to make money. That's his point. As long as you have common sense, patience, and your ears and eyes are open, you can make money. That's his point.
So basically all the human instincts you have to control.
Yeah.
सभी इंद्रियों पे control.
इंद्रियों पे control. इसीलिए I want to do an experiment. मैं वो करना चाहता हूँ कि I want to do an experiment where I would take a control group of traders and a treatment group of traders, and this treatment group would do meditation and all that, like whatever it is, and the control group wouldn't. And then I want to see whether it makes a difference to my gut says, based on all that I have read about these successful investors, this should make a difference. जो इंद्रियों पे control should make a difference in my view. So I don't know, but that's a key point.
Interesting.
This is not for people who look at it like a game or a the worst are those who take it as a personal judgment on their ability. If you are somebody who takes that stock price as a sign of your ability, those people will, because they don't want to accept the defeat, then keep averaging down. Averaging down is a sure shot invitation for losing shirt.
Averaging down in
as the stock price keeps falling. Imagine Paytm 2000 में मिला तो 1800, so 1800 में खरीदा और खरीद लिया क्योंकि मेरा एवरेज कम करना है. So 1500 आया, फिर खरीदा, 1000 में आया, फिर खरीदा, 500 में अभी पैसे S Bank for instance, if you had averaged down from 300, so by now
it's a 10 or 20,
it's 10-12, it's stuck there 10-12, although now I think it's a nice one.
You should buy maybe.
I don't know, I'm no one to say that, but at least but the point is people who take it like that, who start fighting with it, don't take feedback from the market.
Maybe be humble and just pull out the money.
So those kind of people will survive. That's again that Lefebvre says, once you realize you're wrong, just get out. Don't try fighting with the market.
And sit tight when you're right.
Yeah, sit tight when you're right. That one thing that can change your life.
Yeah.